Ever feel like your money just doesn't go as far as it used to? That cup of coffee that was $3 a few years ago is now $5. The groceries that used to cost $100 are now pushing $150. It's not just your imagination. It's a powerful economic force called inflation. So what exactly is it? And why does it feel like we're always running on a financial treadmill? Today, we're going to break it all down. At its simplest, inflation is the rate at which the general level of prices for goods and services is rising. And subsequently, the purchasing power of currency is falling. Think of it this way. If the inflation rate is 3%, it means that on average, things cost 3% more than they did a year ago. Your dollar can now buy 3% less stuff. It's like a slow, silent tax on your savings. So what causes this? Well, there are two main culprits economists talk about: demand pull inflation and cost push inflation. Let's start with demand pull. This happens when demand for goods and services outstrips the economy's ability to produce them. It's the classic too much money chasing too few goods. Imagine everyone suddenly gets a huge pay raise, or the government starts handing out stimulus checks. People have more money to spend, and they're eager to buy cars, electronics, and book vacations. But factories can't instantly double their output, and there are only so many hotel rooms available. When demand is high and supply is limited, what happens? Prices go up. Sellers realize they can charge more because people are willing and able to pay. This creates an upward spiral of prices. Then there's the other side of the coin: cost push inflation. This occurs when the cost of producing goods and services increases. For example, if the price of oil skyrockets, it becomes more expensive to transport goods, run factories, and even make plastics. Companies facing these higher costs have a choice. They can either absorb the cost and make less profit, or they can pass those costs on to the consumer in the form of higher prices. Most of the time, they choose the latter. Another example is an increase in wages. If workers demand to get higher pay, the company's labor costs go up, and again. Those costs often get reflected in the final price tag you see at the store. But wait, there's a third incredibly important factor: the money supply itself. Central banks like the Federal Reserve in the United States have the power to create new money. When they want to stimulate the economy, especially during a recession, they can print more money and lower interest rates. This makes it cheaper for businesses and individuals to borrow and spend, boosting demand. However, if the amount of money in circulation grows faster than the actual production of goods and services, the value of each individual dollar decreases. It's like adding water to juice. The total volume increases, but the concentration or value of each drop goes down. This expansion of the money supply is a fundamental driver of long-term inflation. Now you might be thinking, this sounds terrible. Why is the system designed this way? Why don't we just aim for zero inflation? It's a great question. And the answer is a bit counterintuitive. Most economists and central bankers actually believe that a small, steady amount of inflation, typically around 2%, is healthy for a modern economy. Here's why. First, a little inflation encourages spending and investment. If you know that your money will be worth slightly less next year, you have an incentive to spend or invest it today rather than hoarding it under your mattress. This circulation of money keeps the economic engine humming. People buy things, businesses invest in new equipment, hire more employees, and the whole economy grows. Second, it makes it easier for wages and prices to adjust. Imagine a scenario with zero inflation or even deflation, where prices are falling. If a company is struggling, it might need to cut costs. In a deflationary world, cutting an employee's nominal wage, say, from $20 an hour to $19 feels terrible and can lead to major morale problems. But with 2% inflation, the company can simply freeze wages. The employee's real wage, their purchasing power, has effectively gone down by 2%, but it doesn't feel like a direct pay cut. This greases the wheels of the labor market, allowing for smoother adjustments. Third, and perhaps most importantly, it gives central banks a powerful tool to fight recessions. The main tool a central bank has is the interest rate. When the economy is weak, they lower rates to encourage borrowing and spending. Now, imagine if the inflation rate was zero. The lowest a central bank could push, the nominal interest rate is zero. But if inflation is at 2%, they can set the nominal interest rate at, say, 0.5%. This means the real interest rate, the nominal rate minus inflation, is actually negative 1.5%. A negative real interest rate is a powerful incentive for businesses to borrow and invest because they're essentially paying back less in real terms. It helps a central bank jolt a stalled economy back to life. A target of 2% inflation gives them that buffer, that room to maneuver when things go wrong. So, the goal isn't to eliminate inflation, but to keep it low, stable, and predictable. When inflation is at a steady 2%, everyone can plan for it. Businesses can set prices, workers can negotiate wages, and investors can make long-term decisions with confidence. The real danger comes from high, volatile, and unpredictable inflation. When people don't know if prices will rise by 5% or 15% next year, it creates massive uncertainty. Businesses stop investing, people's savings get wiped out, and the entire economy can grind to a halt. This is what we call hyperinflation, and it has destroyed economies throughout history. What does this all mean for you? It means you could just let your money sit in a savings account earning close to zero interest. If inflation is 3% and your bank is paying you 0.5%, you're losing 2.5% of your purchasing power every single year. That's why understanding concepts like investing is so crucial. The goal is to make your money grow at a rate that is faster than inflation, so your wealth and purchasing power actually increase over time. This could mean investing in stocks, real estate, or other assets that have historically provided returns above the rate of inflation. So, to recap, inflation is the decrease in the purchasing power of your money. It's caused by a combination of high demand, rising production costs, and an expansion of the money supply. And while it can feel like a penalty, small and stable amount of inflation is deliberately targeted by central banks to encourage spending, help the labor market adjust, and give them the tools to fight off economic downturns. It's a fundamental feature of our modern financial system, not a bug. Understanding it is the first step toward protecting and growing your own wealth in the long run. Thanks for watching. If this video helped you understand inflation a little better, be sure to hit that like button and subscribe for more content that helps you navigate the world of money. See you in the next one.